some of the most important changes in a monetary system do not arrive with a crash. There is no alarm bell, no emergency announcement on television, no lines forming in front of banks. Life looks normal. Markets are open. Paychecks still arrive. Retirement accounts still show numbers. And yet, something fundamental may already be shifting. Today, we're going to talk about a decision that is extremely rare in modern monetary history. The Federal Reserve has restarted quantitative easing, QE, without an official financial crisis. No collapse, no systemic failure, no emergency. That's why many analysts quietly call this a silent monetary reset. And if you are still working, already retired, or planning to retire within the next 5 to 10 years, this is not abstract policy talk. It directly affects the value of your savings, the safety of your retirement timing, and how much control you will have in the years ahead. Before we go any further, we need to be very clear about one thing. Quantitative easing is not a routine policy tool. Historically, QE has been used only when the system itself was in danger. For example, 2008, 2014, after the global financial crisis, 2021, during the COVID shutdowns. In those periods, banks were failing. Credit markets were frozen. Unemployment was surging. QE acted like a financial defibrillator. It was used because the alternative was collapse. Why this time is different. This time, the context is very different. Recent data shows the Fed is purchasing roughly $40 billion in U.S. Treasury securities while inflation has not fully returned to the 2% target. Stock markets remain near historical highs. All the banking system is not in emergency mode. That raises a question that makes many people uncomfortable. If there is no crisis, why is the Fed using a crisis-level tool? The answer lies beneath the surface. On the surface, things look stable, but the underlying numbers tell a more fragile story. 1. Inflation, the quiet eroder. Since the pandemic, cumulative inflation is roughly 25% over 5 years. That means $100 in 2019 has the purchasing power of about $75 today. This matters deeply. For workers, inflation eats real wages. For retirees, inflation eats lifestyle. Inflation doesn't announce itself dramatically. It shows up quietly in groceries, in insurance premiums, in housing costs. QE doesn't fix this problem. It often extends it. 2. The labor market may be weaker than it looks. Headline unemployment. Numbers look manageable, but the Fed has acknowledged job creation figures may be overstated by sparkers 20,000 jobs due to survey delays, underreporting from small businesses, statistical smoothing. This suggests something important. The labor market may be cooling more than headlines imply. And for older workers, labor market weakness matters more than for younger ones. Re-entry becomes harder. Wages become less flexible. 3. The Fed's dilemma. The Federal Reserve is trapped between two pressures. Cut rates, risk reigniting inflation, or keep rates high, risk slowing growth and raising unemployment. QE becomes a middle path. No official rate cut, but liquidity still enters the system. This is why QE is being used now, and this is what makes it dangerous. When people hear QE, They often say they're just printing money. That's not wrong, but it's incomplete. QE doesn't just increase money. It changes the direction and timing of money flows. And in any system, who receives money first determines who benefits most. Step 1. The Fed buys bonds. The Fed does not send money to households. It buys treasury bonds, sometimes mortgage-backed securities, from or banks, large financial institutions, in this case, roughly $40 billion less. Step 2. Liquidity enters banks. Banks receive reserves. They suddenly have more liquidity, lower balance sheet risk, greater capacity to lend or invest. But nothing has reached workers or retirees yet. Step 3. Yields fall, assets rise. As the Fed buys bonds, bond prices rise. Yields fall. Investors are pushed out of safe assets into stocks and real estate. This is why QE often lifts markets quickly, even when the real economy is weak. Step 4. The uneven spillover. Money spreads unevenly, typically in this order. 1. Financial institutions. 2. Large corporations. 3. Asset markets. 4. Workers. 5. Fixed income households. By the time money reaches the bottom, prices have already risen. Purchasing power has already declined. This is why QE is often called an inflation tax without a vote. If you are between 50 and 65, QE is not background noise. It directly affects the most fragile phase of your financial life. Retirement is not a low-risk phase. Many people believe, once I retire, risk goes down. In reality, the first 10 years of retirement are the most dangerous because withdrawals begin. Sequence matters. Recovery time disappears. QE tends to inflate markets first, increase volatility later. That combination is toxic for new retirees. Sequence of returns, risk. Simple example, 2 retirees, $1 million each. Average return, 6%. Retiree A. Market drops 20% in year 1. Recovers later. Retiree B. Gains early. Declines later. Same average return. Completely different outcomes. Retiree A may fail. QE increases this risk by encouraging people to retire at elevated valuations. QE hurts fixed income in 3 ways. Bonds struggle to beat inflation. Pensions adjust slowly. Cash loses purchasing power fastest. Retirees relying heavily on cash. Traditional bonds, fixed pensions, are most exposed. QE creates confidence. Markets rise. Headlines improve. Account balances look healthy. This is the most dangerous moment because confidence peaks just before fragility shows itself. History offers a warning. From 1966 to 1982, inflation was persistent. The markets went sideways. Purchasing power collapsed. Many retirees failed quietly. No crash, just erosion. Guidance for 2026. 2026 is not a year for prediction. It is a year for defense, not panic, not speculation. Defense. Principle 1. Avoid forced decisions. QE doesn't destroy people. Forced decisions do. Your primary goal. Avoid selling assets at the wrong time. Avoid retiring just because balances look good. Optionality is survival. Principle 2. Cash flow matters more than returns. In unstable years, reliable spending power beats portfolio size. Ask, How long can I live without touching risky assets? Principle 3. Flexibility beats optimization. The safest retirees are not optimized. They are flexible. 5. 10% spending flexibility often matters more than asset selection. Principle 4. Cash is not dead money. Cash is patience, thus time. Refusal power, a 3 to 5 year expense buffer, can prevent irreversible mistakes. What not to do in 2026. Do not assume QE eliminates cycles. Do not retire simply because markets are high. Do not confuse account balances with safety. The Fed protects the system, not your personal timeline. Risk comes from not knowing what you're doing in a QE environment. Risk also comes from not knowing when you're vulnerable. QE is not good or bad, but it is a warning. Money doesn't only need to grow. Money needs to survive the right period. If you structure your life so that you're not forced, you're not rushed, and you're not dependent on perfect timing, you don't need to predict 2026. You're already prepared for it.